In previous videos, we learned how accountants analyze business transactions, record them in the general journal, and then post them to the general ledger. By the end of the accounting period, the general ledger contains the balances of all accounts and serves as the foundation for preparing financial statements. Before financial statements can be prepared, however, accountants must verify account balances, record any necessary adjustments, and organize the information into a format that can be used to prepare financial statements. In a manual accounting environment, this process is often accomplished with the help of a worksheet. In this video, we'll learn how accountants use the worksheet to organize account balances, prepare adjustments, and build the financial statements step by step so that you can see how the worksheet is the bridge between the general ledger and the financial statements. Preparation of the worksheet is the fourth step in the 9-step accounting cycle and an important accounting tool that allows accountants to prepare a trial balance, record adjusting entries, prepare an adjusted trial balance, and ultimately develop the financial statements. Although most businesses today use accounting software that performs many of these steps automatically, understanding the worksheet helps you see how information flows through the accounting cycle and how the financial statements are created from the underlying accounting records. Today, it is relatively uncommon for accountants to prepare worksheets entirely by hand, but the concepts remain important. In fact, as part of a business acquisition several years ago, I worked with a company whose owners required the accounting team to maintain many of their accounting records in Excel because it was the system they were most comfortable using. While unusual, situations like this remind us that understanding the manual accounting process remains a valuable skill for accountants. This is what the worksheet looks like. At the top of the worksheet is the header, which shows the name of the business, Eli's Consulting Services. On the first line, on the second line is the name of the document, the worksheet. And on the third line, the month for which this worksheet is prepared, in this case, December 31st. The worksheet has multiple sections, the account name in the first column, the trial balance debit and credit columns, the adjustment section with a debit and credit column, and the adjusted trial balance, which is calculated by taking the amounts of the trial balance plus minus the adjustments. The last two sections are for the income statement and the balance sheet. Just a reminder, the worksheet is not a formal financial statement. It's a tool used by the accountant to prepare the financial statements. And because we're learning the manual process for accounting, you're preparing it. However, in a company with a computer software, the system would generate it for you. The accountant begins the worksheet by reviewing all the general ledger accounts that journal entries were posted to, and then enter the account names into the account name column and the debit amounts from the general ledger accounts into the debit column and the credits into the credit column. Accountants often know that they will need additional accounts that are not yet listed on the trial balance, like for accumulated depreciation and depreciation expense, because the accountant will be recording adjustment entries for these accounts. So the accountant already enters those account names even though they don't yet have a balance. Now, if that sounds a little confusing, it will be less confusing as we work through the examples. Then the accountant tallies up all the amounts in the debit column and credit column of the trial balance section, and if you've done everything correctly, meaning you transferred the amounts correctly, the total debits should equal the total credits. At the end, you place a double rule under each trial balance column to show that the work in that column is complete. And we'll do that now for Eli's Consulting. So first we'll enter all the GL account names for Eli's Consulting into the account name column. And here I've already added 4 new accounts that I know we'll use later because we'll record adjustments that impact these accounts. These accounts are accumulated depreciation, supplies expense, rent expense, and depreciation expense. You might need additional accounts if there are additional adjustments to record. You can either leave enough space to write the names of the accounts that you'll need later, or you can just add them at the very bottom. The next step is to look at each general ledger account and transfer the general ledger balance to either the debit or credit column of the trial balance. So the cash general ledger account has a debit balance of $111,350, and we'll transfer that amount to the debit column of the trial balance. Next up is the accounts receivable account, which shows a debit balance of $5,000, and we transfer that amount to the trial balance as well. Here I've completed the trial balance section by filling in the balances from each of the remaining general ledger accounts and summed up all the debits and summed up all the credit amounts. The total debits match the total credits, but it's really easy to make a mistake here. And you can't complete the rest of the worksheet until you figure out why the debits don't balance with the credits. Typically, it's because you've entered a general ledger debit balance as a credit balance, or you've transposed a number. Once you've completed a section, you place a double rule under each column to show that the work in that column is complete. Again, this work would only be done if you're working in a manual accounting environment. When I first started working in accounting quite a few decades ago, before desktop computers, laptops, Microsoft, Apple, and so on, the work was actually being done this way. So you can probably tell with all the changes I've seen in the industry, you will likely see just as many changes. And even though this is an automated process now in most companies, it is important to know the fundamentals. We're now ready to start with the adjustments and the adjustment column of the worksheet. Adjusting entries are the process of reviewing all general ledger accounts to check that they have the right balance and adjusting them as necessary. Think of it like cooking a meal and tasting it at the end to add some additional salt, pepper, or paprika to perfect the dish. Eli's Consulting's first adjustment is for the supplies. Do you recall that the supplies were purchased from Office Deluxe for $1,500 on November 28th? At the beginning of December, Eli's Consulting still had $1,500 in supplies, and at the end of the month of December, $1,000 in supplies still remained. However, our trial balance shows $1,500 when only $1,000 are still remaining. So that means that $500 were used up and now are considered an expense. Let's analyze this transaction the same way we did before. Supplies expenses have increased by $500 because the supplies were used up and are no longer an asset. Supplies expenses are an expense account, and according to the dealer mnemonic, increase with debits. The supplies account decreased by $500 because only $1,000 of the supplies remain. The supplies account is an asset, and assets decrease with credits. So debit supplies expenses and credit supplies. As a side note, many companies choose to not record supplies as an asset because the amount is below the company's materiality threshold. Sometimes, though, parts can be very pricey and perhaps cost $50,000 or more per part. That's a material amount, and unless the company uses this supply part rather than keeping it in reserve, it should remain on the balance sheet. We're now ready to enter this adjustment for supplies expenses of $500 into the worksheet now. We'll record the debit of $500 first in the debit column of the adjustment section in the row for supplies expenses. Next, we'll record the credit of $500 in the credit column of the supplies account. At this point, I recommend that you check the total debits and the total credits after each adjustment to double check that you're still in balance. Our total debits of $500 equal our total credits of $500, and we are in balance. Our next adjustment is for prepaid rent. On November 20th, Eli's Consulting Services paid $8,000 for the December and January rent. We recorded it as a prepaid rent at that time. As of December 31st, the prepaid rent account still shows $8,000 in the prepaid rent account. However, Eli's Consulting has used up the rent for December, and we now need to record it as an expense. Why? Well, the December rent portion is no longer an asset because Eli's Consulting has used the building the entire month. Let's analyze this transaction. We now have more rent expenses. Rent expenses are expenses, and according to the dealer mnemonic, expenses increase with debits. So debit rent expenses. We also have less prepaid rent. Prepaid rent is an asset account, and asset accounts decrease with credits. So a credit to prepaid rent. And we're now ready to record this entry in the worksheet. We'll record the debit of $4,000, the first month rent, first in the debit column of the adjustment section in the row for rent expenses. Next, we'll record the credit of $4,000 in the credit column of the prepaid rent account. Again, please check the total debits and the total credits after each adjustment to double check that you're still in balance, which we are because both columns show $4,500. The next adjustment is for depreciation, which is the process of estimating how much the company's assets have lost in value month over month and year over year. And we can probably all agree that the assets the company previously bought are not worth as much as what the company paid for it a month later. It's not that different from supplies that were used up and expired prepaid rent. We just estimate the amount that's been used up. But imagine if a large company would have to assess how much value each of their assets still has. That would be a lot of work and not really realistic. So we use standard processes for depreciation and estimated useful lives to approximate how much value an asset still has. Is it super exact? Absolutely not, but it is a good estimate. So let's cover the different methods quickly. There is straight line, declining balance, sum of the year's digits, units of production, and double declining balance method. The IRS requires the use of a depreciation method called MICRS unless it's an asset purchased before 1987. Later accounting classes will cover these methods in more detail, and we will focus on the straight line method in this class only, which is what Eli's Consulting is using. The straight line method spreads the purchase cost less salvage value in equal portions across the estimated life of the asset. Salvage value is the amount that you expect to sell the asset for at the end of its life. So now let's talk about the estimated useful life. There are different ways of calculating the useful life, but there are also guidelines that are issued by the IRS. Many companies use a standard of 5 years for furniture and fixtures, 10 to 20 years for manufacturing equipment, and perhaps 3 to 5 years for computer equipment. And two things to mention before we calculate the depreciation for Eli's Consulting. Generally accepted accounting principles require that the original cost of the long-term asset continue to appear in the asset account until the asset is disposed of via a sale or thrown away. That means that the depreciation we record does not reduce the asset account directly. Instead, we'll use a contra asset account called accumulated depreciation so that we can see both the original purchase price of the asset and the depreciation we've recorded since the purchase. Now that you know the basics about depreciation, we're ready to calculate the depreciation for Eli's Consulting equipment assets. Eli's Consulting Services purchased equipment in November for $11,000. The useful life is 5 years. The salvage value is $0 because Eli's Consulting believes that the equipment will not be worth anything at the end of the useful life. And as I mentioned before, Eli's Consulting Services uses the straight line method. So to compute the depreciation for the month of December, we subtract the salvage value, which in this case is $0, from the cost of the asset, leaving us with $11,000, and then dividing that amount by 60 months, which is 5 years in month. The amount of the monthly depreciation is $183. As I mentioned previously, depreciation is not recorded directly as a reduction to the asset account. Instead, we're now using a new account called Accumulated Depreciation Equipment, which is also called a contra asset account and has a normal credit balance, even though it's an asset. An additional term that is often used in connection with assets is the book value. The book value is the net asset value after depreciation, which means that you take the original cost of the equipment and you subtract the accumulated depreciation from it. And in our case, it is $11,000 minus $183, which equals $10,817 as the book value. To find the debit and credit for the depreciation, we analyze the transaction as we've done previously. We now have more depreciation expense, which is an account in the expense category, and expenses increase with debits. That means we have to debit depreciation expenses. The second part of our transaction is that we now have more accumulated depreciation, which is a contra asset account. This is a bit tricky because this account behaves in the opposite way of an asset. Asset accounts increase with debits and decrease with credits. Contra asset accounts increase with credits and decrease with debits. So we credit accumulated depreciation. We'll record the debit of $183, the first month depreciation, first in the debit column of the adjustment section in the row for depreciation. Next, we'll record the credit of $183 in the credit column of the accumulated depreciation equipment account. Again, please check the total debits and the total credits after each adjustment to double check that you're still in balance, which we are because both columns show $4,683. And since this is our last adjustment in this exercise, we also double rule the adjustment column to show that the work here is complete. Next, we complete the adjusted trial balance columns by adding or subtracting the amounts in the trial balance columns and the adjustment columns. Just keep in mind that only the 6 accounts from the trial balance columns that had adjustments now have a new amount in the adjusted trial balance columns. All others remain unchanged from the trial balance columns, like for instance the cash account. The balance in the trial balance columns was $111,350. There was no adjustment in the adjustment columns, and therefore the amount in the adjusted trial balance columns is $111,350. On the other hand, the supplies account had a debit balance in the trial balance columns of $1,500, but a credit of $500 in the adjustment column, which reduces the remaining debit balance to $1,000. When you've completed the adjusted trial balance amounts for all accounts, total both columns and ensure that both debits and credits are the same. In this exercise, the total debits and credits in the adjusted trial balance columns are $150,683. Next, we'll sort the amounts in the adjusted trial balance columns into the balance sheet accounts and income statement accounts. We enter the balance sheet amounts in the balance sheet columns and enter the income statement amounts into the income statement columns. All the accounts from cash to Trayton Eli drawing are balance sheet accounts, whereas the fees income to depreciation expense are income statement accounts. There is a special step at the end after you've completed the income statement and the balance sheet columns. You total the columns, but they won't equal. Do you recall that we said that the profits or losses for that matter belong to the owners of the business? That is why we transfer the profit for Eli's Consulting of $33,667 first to the balance sheet for it to balance. You start first in the income statement columns by subtracting the expenses from the fees income, and you enter the net income into the debit column, and then you total the columns. You also enter the same amount, the net income of $33,667, into the balance sheet column as a credit, and when you total the balance sheet columns, they should now balance as well. Is that it? Not quite. The next step is the preparation of the financial statements, which is step 5 of the accounting cycle. And we also need to journalize the adjustments from this worksheet and post them to the general ledger. In this video, you learned how accountants use the worksheet to organize account balances, prepare adjusting entries, and develop the financial statements. You also learned that before financial statements can be prepared, accountants must ensure that revenues and expenses are recorded in the proper accounting period and that account balances accurately reflect the financial position of the business. Understanding the worksheet helps you see what is happening behind the scenes and why adjusting entries are necessary. More importantly, it helps you understand how information flows through the accounting cycle. Think of the worksheet as the bridge between the general ledger and the financial statements. It brings together account balances, adjustments, and financial statement information in a single place, helping accountants transform raw accounting data into meaningful financial reports. And as we continue through the accounting cycle, we'll build on these concepts and take the next step toward preparing and closing the accounts for the accounting period.